What's going on, everybody, and welcome to this video where we are going to be talking about the pros and cons of dividend investing, dividend growth investing, all that good stuff. Now, a little disclaimer is that I personally myself am a dividend growth and dividend yield investor, so I am going to be a little bit self-biased, but I'm going to do my best to give all the cons that I can to show you guys the actual benefits and the non-benefits of investing in dividend stocks rather than choosing growth stocks or just choosing simple ETF index fund investing. So before I go any further within this video, all I ask that if you enjoy it, you make sure to give this one a thumbs up and you subscribe. You turn on those post notifications for videos coming out every other day. All we do in this channel is talk about dividend stocks, dividend investing, passive income, all that stuff. So if you're interested in any of that, make sure to stay tuned and subscribe for future videos and don't miss out on anything like that. But enough of this talk. Let's get into this video. So what we're looking at right now is a portion of my portfolio. This is the tech and cloud computing section of my portfolio on M1 Finance. You can see some of my top holdings in here are Apple, Microsoft, Broadcom, and then the other two are IGV, which is a tech software sector ETF, and NVIDIA. Now, I put these in there because I believe that these companies have huge growth potential and that they pay a small dividend yield. All of them pay a little bit of dividend yield, except Broadcom's is a little bit higher. But what we'll see is I believe that long term, because I'm thinking very long term in my portfolio, 5-10 years plus. I'm thinking very, very long term so that whenever I'm older, that this portfolio can pay for my lifestyle and my yield on cost in these companies will be incredible. This is just the tech and cloud computing part of the portfolio. My M1 Finance is acting a little bit weird, so it's not giving you my total portfolio performance. But we'll see I have Income Fund, which is just some ETFs. You can see JEPI, SCHD, XYLD. Now, I actually just unbalanced my Income Fund, and I bought a lot of XYLD. You can watch this on my past video. I will put a card up to this video right now, so you don't miss out on any of that future stuff. But enough looking at my portfolio. This isn't a portfolio reveal video. Let's talk about this, the pros and cons of being a dividend investor. So I am a dividend investor, and I believe that the pros do outweigh the cons, especially for the long-term benefits provided through dividend growth investing. But let's talk about the pros. So what are the actual pros to dividend growth investing, investing in singular dividend stocks? First off, we can always, the obvious, it provides cash flow on a consistent basis, okay? Monthly, quarterly, you get the gist. Sometimes it's semi-annually, sometimes it's annually. So this is my favorite thing, is that it provides cash flow on a consistent basis. Now, what we'll talk about is number two. Dividend-paying stocks have historically performed better than non-paying stocks. I've seen studies where they look at this stuff, and dividend-paying companies are doing far better than non-growth. I believe, if you were to invest $100 in 1999, right before the dot-com bubble, and did not get any dividends from the S&P 500, your $100 would be worth like $78. No, it might have been worth like $96. Either way, that's beside the fact. It was a negative number. But if you would have had dividend income coming in, not even taking dividend reinvestment, you would have ended with $118, which is an 18% return. So that's the power of dividend investing, especially in bear markets. So that is another big pro, is that they are better in flat and bear markets. So to give you a visual effect of what that looks like, here's just a little drawing I came up with, okay? I'm not an artist, so hopefully you enjoy the writings. What we'll see is that this is just kind of a flat market. It goes up, down, and it kind of just stays flat. But you know what you're getting throughout this whole time is your dividend payments. You're still getting gains because you have a dividend income coming into your portfolio and that cash flow being generated on a monthly, quarterly, whatever it is basis. Now, in a bull market, it's even better because you're getting capital appreciation as well. Now, in a bear market, in a crash, a correction, whatever it might be, you're sure your stock capital price appreciation is actually depreciating, but you're getting these dividend payments. And that is the number one thing, is that it's a hedge against a bear market. Now, you don't want to strictly invest in bad companies. Now, don't get me wrong. I've talked about AT&T stock on my channel before. I made a video on my analysis on why I don't like the stock. But it's down 33% over the past 5 years. Over the past year, it's down 14.65%. I don't want to invest in companies that can't come to prove themselves that, hey, our stock is worth more than it is today, and they continually downtrend. Now, I'm not saying that past performance equals future performance, but it's just that AT&T, I don't think there's any future ahead of them that's as bright as people are anticipating. everybody's here for the dividend because they have a yield of like 8%, but it's about to get cut in half and different things are happening for the company. But that's just my number one thing, is if you're going to invest in a company, have the anticipation that the capital price is going to appreciate and not depreciate. So thirdly, dividends make up a large percent of the S&P 500 in total stock market returns. Check this out. Going back to 1970, 84% of the total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding. Look at this portfolio. Gray line is your S&P 500 with no dividends, and your S&P 500 is this blue line with reinvesting dividends. That's a massive difference in portfolios. Fourth up, the dividend snowball effect and drip. I can't stress this enough. The power of these two is insane. Let's say you start off with $10,000, okay? You have 1% dividend yield, so that's $100. You know what? Let's go with a more useful, a more real dividend yield, $300. Well, 3%, so it's $300 on an annual basis. You get this money. Now you have $10,300, and let's say your stocks appreciate a little bit. Well, now you still have this $10,300, and the next year you're going to get 3% on that, which is going to be more than $300. And it's just going to keep slowly rolling in, and your dividend snowball is going to keep rolling down the hill, and your portfolio is going to keep getting bigger, and it's going to keep paying you in bigger amounts, especially whenever you turn on that dividend reinvestment plan. It's insane, the upside potential. Whenever the key ingredients to success in dividend investing is, one, having drip on at least for whenever you're starting. At least for the first few years until you get your portfolio to actually provide your income, have drip on, okay? And consistently put money into your account and buy stocks that you have conviction in, ETFs, whatever it might be. Now let's talk about the fifth pro, the power of the dividend yield on cost. Investing in companies and then their share price appreciates incredibly because they're a growth company with a dividend, for example, Apple or Microsoft. It's things like that. And then you would pay, let's say you paid $100 for the share, has a 1% dividend yield. But then the share price appreciates to 3%, $300. Now your dividend yield on cost is like 3%. Okay, you tripled your yield on cost just by that. And it's whenever you get the big companies and the big growth that makes it insane. Warren Buffett is doubling his money every single year, or every 2 years, from Coca-Cola because its yield on cost is so insane. Now another pro is the emotions when it comes to dividend investing. I know whenever I wake up in the morning and I see my M1 Finance say, hey, you've got $11 in dividend income today. Like, sure, it's $11. It might not be the most money in the world, but it's still there. And I did literally nothing to get that $11. I literally woke up out of bed and I saw I have an extra $11 to my name. And it's incredible things like that. And $11 today, think about 10 years from now. Whenever I add more money to the account, I reinvest these dividends. That $11 could be $1,100, on a single day. It's incredible the power of just emotions that makes you like dopamined up to keep investing in dividend stocks. Now we talked about how it's better in flat and bear markets, and these dividend stocks are seen as less risky because most of these companies paying a dividend are more established. So what that means is like these companies have big profits and they just have so much money they're paying it out to shareholders, and they're more established than your risky, your penny stock, your growth stock. That's a little bit newer company. And ninth, it is a hedge against inflation. We've seen inflation go very high recently, and so this is a very good hedge against inflation with its highest rates in the past 30 years. Let's talk about the cons of dividend investing. Taxes. Okay, you can usually buy and hold a stock for a very long time. You can buy and hold stock for however long you want. Let's say you hold it for 5 years. You don't have to pay you don't have to pay any taxes on that until you sell that stock. But with dividends, you have to pay taxes on your dividends as they come in, on that monthly, quarterly, whatever basis it is. And the current dividend yield right now, the current dividend tax rate right now, you can just see like single filers, it gets up to about 20% as long as you've been holding them for at least 60 days, I want to say. And number two is there's slower growth. So if you look at growth stocks, you can look at other companies like, just take for example, Nvidia, or another company. Let's think about a growth stock like Neo, okay? These companies are growing at insane rates. And dividend stocks don't often grow as fast as growth stocks, but in the long term, they do perform better. And that's what I'm thinking with my portfolio, is a very long-term outlook. Now, third, they have less potential for massive stock gains, just like we talked about. I mean, you can just like, this kind of relates to number 6, emotions, seeing others' gains and price watching. Like everybody, GME, we saw GameStop go insane. It's up 1,100% just the past year. It went all the way up to $347, and that doesn't include pre-market or after hours. I think it went up to like 500 something, if I'm not mistaken. Like the stock went to 500 from $18. I mean, you actually look at how low this stock was. It was literally down here at $3, and then you could have bought it and sold at 500. You know, that's insane stuff, and you don't see that with dividend stocks. You know, and then fourth, companies are not required to pay dividends. Like, these companies are not legally obliged to pay you a dividend. They're doing it because it provides value to the shareholders, and it's a good thing for them to do it, but they're not doing it because they're required to, and they can honestly cut that whenever they feel like they want to. Fifthly, dividend yields often aren't super high, and if they are, they're probably going to get cut. And what I mean is that usually a high dividend yield is like 8%, and I mean 5% is even high, 4% is pretty high too. But people might look at this and be like, it's only 8%. Like, the market returns 9, 10%. Why would I pay 8%? Or I know that this growth stock over here is like gonna 200%. But it's the fact that you're getting cash flow on your portfolio, and that the dividend yields aren't super high. And if they are, they're probably gonna get cut. Those are the ones that are like 20% on a company with a payout ratio of 200%. Like, it's gonna get cut, you know. And a lot of people don't like to see that the dividend yields aren't incredibly high. But usually those gains that you make whenever they're 100%, whatever it might be, aren't sustainable. And then we'll look at 7, because we already talked about the emotions, patience. Dividend investing is a very patient game. It's not a get-rich-quick scheme. It is all about being patient, okay? You have to wait years. It just depends, you know. You can start with a big portfolio, and you just slowly start to notice this dividend snowball effect kicking in. And it's insane, the upside potential that brings. Because in the long term, sure, you put money into this account, and at some point in time, this account is going to be paying you incredible amounts. You're not even going to have to worry about studying these stocks, so you can go over and get 100% gains, because your portfolio is going to be bringing in so much cash that you don't even care. Okay? You're going to have too much money to deal with. And 8, I'll talk about bonds. A lot of people look at bonds and dividend stocks very similar, and they say that, well, bonds are safer because they pay just straight interest. And I know that bonds do fluctuate in price, but not as much as a dividend stock might. And so they say that bonds are a lot safer, but I do like dividend stocks over bonds, but it is an option that people think of as a con towards dividend investing. But everybody, that is what I have for you in this video. So if you did enjoy it, make sure to subscribe. Turn on that post notification bell for videos coming out every other day. I always like to see what you guys are doing, what you guys are thinking. So make sure to leave a comment down below what you think about. Maybe you have some other pros or cons that you want to add in to the rest of the people. So make sure to leave a comment and let everybody else know what your thoughts are. Thank you again for making it to the end of the video. Check out M1 Finance in the link description below. You can get my portfolio for free. You can check out the link and just get some free $30 for signing up and depositing $100. But everybody, thank you so much, and I will see you at the next video.